Warren Buffett has said that accounting is the language of business. So if that's the case, then this video is the Duolingo of business. The intention of this video is not to teach you how to become a CPA, but rather, if you're a small business owner and you don't know anything about accounting, this is a great place for you to start because I'll teach you the basics, I'll teach you how to understand accounting, how to think about it, and a couple of examples of how you can get started with doing your own transactions. Now, if that sounds like something you're interested in, let's get straight to it. The first thing we want to know is what actually is accounting. Now, accounting refers to the processing and recording of a business's financial information. It's really as simple as that. But this is super important. If you run a small business without knowing accounting, then you're going to be completely lost when it comes to tax time. And that is if you even make it that far. It's quite likely that you'll run out of money and go out of business without even knowing what happened if you don't know how to do accounting properly. So we're going to go over that very briefly in this video. So we're going to be following what's called the GAAP, or the Generally Accepted Accounting Principles. These are a set of principles that have been, generally accepted, as the name goes. Basically everywhere in the world uses something similar to this, and it's the fundamental framework for every other financial reporting system that you may use. Essentially what that means is it's universal accounting, so no matter where you are in the world, you can use it. And we're going to learn the difference between single entry and double entry accounting. Now, if you've ever made a budget for yourself, chances are you've already done some single entry accounting, where you just record the amount of money that goes towards your rent or your groceries or whatever. Double entry accounting is a little different, and that's what businesses use, where we will track things like debits, credits, assets, liabilities, etc. Chances are you've heard those words, but we're going to learn what they are and how to use them today. So also, what is an account? An account is really just a fancy name for a balance, a total, or a category. Think things like office supplies, cash, loans, etc., whatever it is that you might have in your business. And again, personally, if you have made a budget, you've most likely used accounts without knowing it. So breaking down your budget into groceries or rent or utilities or whatever, those are all different accounts. In business, there are 5 broad types of accounts, and these are the rough definitions of each of them. There are assets, and these are the things that you own. Liabilities are the things that you owe. So if you owe an amount to someone else, that's a liability. There's equity, which is the net worth of the business, or how much is left over once you pay off all of your liabilities. It's similar to your personal net worth. There's revenue, which is money earned by the business, and I should say money earned in the normal course of your business. And there are expenses, which is money spent by the business while earning revenue. Some examples of assets would be cash, accounts receivable, which is an amount that your customers would owe you if you've sold them a product but they haven't yet paid you for it. Investments, inventory, equipment, vehicles, even things that aren't physical such as patents, as well as a lot more. There are many types of each of these. We're just going to go over a couple of the most common ones here. Liabilities, some examples of those include accounts payable, which is the flip side of accounts receivable, and these are amounts that you owe to your suppliers for things that you've purchased but haven't yet paid for. There are bank loans, private loans, things like sales tax is refundable. If you've received sales taxes from your customers, then you have to refund them back to the government. That's a liability. Equity is a little more straightforward. There are really only a couple of accounts in equity that we need to worry about. There's the owner's equity, which is the amount you've invested in the business. The owner's draw, or owner's drawings, the amount that you've withdrawn from the business. Those are equal and opposite to one another, as you can see. There's net income, which is your revenue minus your expenses for the current year. And then finally, there's the retained earnings, which is the cumulative net income for all of your previous years in business. Now, that doesn't include this year's net income, but it's everything from the years prior. If you're a corporation, these are going to be a little bit different. Instead of being owner's equity, it would be something like common stock. And instead of being owner's draw, it'd be dividends. But again, for the sake of this is a pretty simple business we're looking at. Owner's equity, owner's draw, net income, and retained earnings. Now, revenue, I mentioned before that revenue is an amount you earn from selling products in the ordinary course of your business. So, for example, if you sell branded t-shirts, let's say, you'd record the value of the shirts that you sold in revenue accounts. However, if you took an old machine that you used to make the t-shirts and you sold that on Craigslist, that would not be considered revenue because it's not your ordinary business. Your ordinary business is making t-shirts, not selling t-shirt making machines. Now, expenses. Expenses are amounts you paid in order to generate revenue. That's a key part there, is that it was paid in order to generate revenue. Some examples include advertising, meals and entertainment, software subscriptions, rent, utilities. There are really tons of expenses, and basically anything that you purchase that isn't a physical asset that you'll hold on to would be an expense. So now that we've gone over what the types of accounts are, let's go over how to actually use that information to enter a transaction into your accounting books. So as you can see here, I have an accounting transaction in the table there, where we have a debit to cash for worth $10,000 and we have a credit to owner's equity for $10,000. Now, what does all that mean? This needs to follow two golden equations of accounting. The first being that assets minus liabilities equals equity, and the second is that debits equals credits. Now, specifically, remembering that debits equals credits is crucial for entering accounting transactions properly. So what is a debit and a credit? Debits and credits are the words used to differentiate different types of transactions in accounting. Debits and credits increase or decrease different account types, which we'll go over, and each account is either considered a debit balance or a credit balance. Accounts that are considered to be debit balance accounts are accounts where debit entries will increase the value of that account, whereas a credit entry would decrease the value of that account. If this sounds a little bit like gibberish, I promise it'll make more sense once we get into examples, but just remember that debit balance accounts are assets and expenses. Debit balance accounts are assets and expenses. Conversely, credit balance accounts are accounts where credit entries will increase the value of the account, and these include liabilities, equity, and revenue. A debit entry will decrease a credit balance account. So whenever you have an account balance that's credit, a debit entry will decrease it. If you have an account balance that's credit, a credit entry will increase it. Credit balance accounts are liabilities, equity, and revenue. Credit balance accounts are liabilities, equity, and revenue. This is very important. So going back to that original example of the $10,000, how would we actually enter this? So what this transaction is you investing $10,000 of your personal funds into the business. If you think about the logic of what's going on here, your business cash value goes up. Since cash is an asset account and assets are debit balance account, as we learned before, you enter a debit of $10,000 to the cash account. And that's what we see in the first line of that table there. Now that we have the cash sorted as a $10,000 debit entry to the cash account, we know that we need to balance that out with an equal credit entry to a different account. Because we're investing our funds into the business, this would be an increase in your owner's equity account, since owner's equity tracks the investments in the business that you've made. Because an owner's equity account is under the equity category, they are credit balance accounts, which means that we would credit owner's equity by $10,000. Now this satisfies our need for debits to equal credits at $10,000 each, and it increases owner's equity by $10,000, meaning that everything here makes logical sense. As you can see, to recap, cash is an asset, and we have $10,000 as a debit entry. Owner's equity is an equity, and we have $10,000 as a credit entry. So therefore, debits equal credits, and also our assets minus our liabilities equals equity, because we didn't have any liabilities to speak of in this transaction. It was just assets and equity, and our assets increased and our equity increased. Therefore, assets minus liabilities equals equity. So I know that can be confusing when it's the first time you've really entered that. So we're going to look at a couple more transaction examples so that we can make some more sense of it. And I promise it's only confusing because it's new. Once you get the hang of debits and credits, and that starts to make sense logically in your brain, it'll make a lot more sense. And remember as well, try and piece together what's actually happening in the real world with the transaction, much like we did with that owner's equity. So we're going to look at 4 more examples now. We've already done the $10,000 investment. We're going to look at receiving a bank loan of $5,000, purchasing equipment for $12,000, making our first sale for $2,000, and then finally paying our electricity bill totaling $1,000. So here are the entries for all of those transactions. The first one here being the bank loan. So because we took out a bank loan, we received cash, and in the future, we're going to have to pay that back. That is a $5,000 liability, which is the bank loan credit account, and it's a $5,000 increase in our cash, which means we debit cash by $5,000. The second one is the equipment purchase. Now, when we buy equipment, that's considered to be an asset because it's something that we own. It's a piece of fixed material that we own and we'll use to make profits in the future. So that increases the equipment asset account by $12,000. We purchase it with cash, which means that our cash balance decreased. So as we know, if there's a debit balancing account, such as cash, a decrease in that is a credit entry. So therefore, we entered $12,000 on the credit side to balance out the transaction. Next, we have our sales. So if we've received $2,000 in sales, you can think about your customer paying you the $2,000. That means that your bank balance will go up by $2,000. So we debit cash for those $2,000. And as well, As we know, revenue is a credit balance account. So when we increased our revenue, we increased our sales by $2,000. We enter a $2,000 entry into the credit column for sales. Finally, to pay our electric bill, we'll use the utilities expense account. As we know, we're increasing the amount of expenses paid, so we would increase a debit balance account expense, which would mean it's a $1,000 debit entry. And we've paid the cash has left our bank, so our cash balance decreases. And since cash is an asset, which is a debit balance account, we would enter a credit of $1,000 to decrease our cash balance. I recommend that you go back and take a look at these transactions and maybe take a look at this again if you aren't understanding it. Try and really pause this video and get as much out of this as you can, because this is the fundamentals of accounting. You're really going to need to know this. Now that we have all these transactions written out as debits and credits, we can now summarize them to see what the net amounts in each account are at the end of the period. So for all these transactions, we used 6 accounts. We used cash, equipment, bank loan, owner's equity, sales, and utilities. And as you can see, we have a breakdown of all the transactions that have happened in them. These are what's called T accounts, but it's basically just a summary of the debits and the credits. So what we're doing is we're adding together all of the debits and subtracting all the credits for the debit balancing accounts. And we're doing the opposite for the credit balancing accounts. Now, the only one that actually has multiple entries in this case is cash. But as you can see, we have our $10,000 in the cash account, which is from the owner's equity. We also increased by $5,000, which is from the bank loan, and we increased by $2,000 from our sales. We purchased the equipment for $12,000, so we decreased by $12,000, and we paid our electric bill for $1,000, which means that we also decreased by $1,000, which when you add all that up, adding the debits and subtracting the credits, you get a net debit balance of $4,000. Equipment is more simple. All we did was purchase the equipment, so we just have the $12,000 debit entry, which creates a net debit balance of $12,000. Same thing for the bank loan. All that we did was establish the loan, so we have a credit entry of $5,000, leaving a net credit balance of $5,000. Owner's equity, we invested the $10,000 into the business, which is a credit entry of $10,000 and a credit balance of $10,000. For sales, we had that one sale for $2,000, which results in a credit entry of $2,000 and a credit balance of $2,000. And finally, utilities, we paid the electric bill for $1,000 for a debit entry of $1,000, creating a net debit balance of $1,000. Now remember, our two equations that we need to satisfy are that debits equals credits and assets minus liabilities equals equity. So first, we'll see if the debits equal the credits. So as you can see from the summary on the bottom, and you can do the summary yourself if you want, our total debits are $17,000. We have $4,000 in cash, $12,000 in equipment, and $1,000 in utilities. That equals $17,000 debit balance. Our total credits is also $17,000, where we have $5,000 in the bank loan, $10,000 in the owner's equity, and $2,000 in the sales. Therefore, debits equals credits, and we've satisfied the first condition. From here, what we can do with these account summaries is produce essentially the end product of the accounting cycle, which are financial statements. Now, there are a lot of financial statements, but I'm going to go over the two most common that you'll use in your business, and that's the balance sheet, sometimes referred to as a statement of financial position, and the income statement, which is sometimes referred to as your profit and loss or your P&L. So first, the balance sheet. What the balance sheet does is it shows your assets and your liability and equity. So we can use this to determine whether assets minus liabilities equals equity. So as you can see, the cash and equipment are our two asset accounts. So our total assets there is $16,000. For liabilities and equity, we only have the one liability account, which is the bank loan for $5,000. We have the owner's equity account for $10,000. And we have a new equity account here that didn't appear in our account summaries, and this is net income, which I'll show you on the next slide. That results in a total liabilities and equity of $16,000. As you can see, assets equals liabilities plus equity, and if you remember your algebra, that is the same as saying that assets minus liabilities equals equity. So that satisfies our second accounting equation. Now the next financial statement is the income statement, and that is what's going to give us that net income figure that you saw on the balance sheet. So in order to have one, we need to have the other. The income statement and the balance sheet go hand in hand. So what we do for the income statement is very simple. We take revenue, which in this case is just our sales, $2,000 for a total revenue of $2,000, and we subtract our expenses. Again, very simple in this case, just utilities of $1,000, which leaves us with a total net income of $1,000. And as you saw before, that's what appears on the balance sheet. So to recap, we learned what the 5 different types of accounts are in accounting. We have assets, which again is a debit balancing account. We have liabilities, which are credit balancing accounts. Equities, also credit balance. Revenue, also credit balance. And expenses, which are the other debit balance account. We also learned what debit and credit balances mean. If you're not familiar, you can skip back and watch that again. We learned the 2 equations that are fundamental for this, which is assets minus liabilities equals equity, and the debits must equal credits. And we also went over briefly the accounting transactions, as well as producing the balance sheet and the income statement. Now, with all this information, you should be able to go in and produce some basic financial statements for your business. I recommend doing this either in Excel or something, and there are also accounting software out there that can do this for you, but honestly, if your business is really small, it might be worth just starting in Excel and then seeing where you go from there. You can always upgrade to something like QuickBooks or something more advanced than that in the future. If you have any more questions, feel free to leave a comment below, or if you want specific help, you can go to my website, which is linked in my bio, and I'd be happy to help you out over a call. So thank you very much for watching. I appreciate it, and I hope that you got something out of this. Take care. Peace.